Hi everyone, and welcome to the Breaking Fraud series. In this video, we'll explore how credit card transactions worked back in the 1950s to 1970s, long before computers and the internet transformed the way we pay today. We'll walk through the roles of customers, merchants, banks, and card networks, breaking down how payments moved through each stage. Let's get started. Before we dive into how credit card payments actually work, let's take a moment to understand the main players involved in the process. Customer, the individual making a purchase using a credit card. Merchant, the business selling a product or service to the customer. Acquiring bank, this is the merchant's bank. If a customer's payment is approved, the money gets deposited into this bank account. Card network, a system that connects banks and facilitates communication between acquiring and issuing banks. Issuing bank, this is the customer's bank. If the payment is approved, the money is taken out of this account. To make sense of how credit card payments worked in the early days, it helps to break the process into simple, clear steps. We'll walk through 7 key stages, tracing the path of a transaction, from the moment a customer makes a purchase to when the merchant receives the funds. The customer initiates a purchase by providing their card to the merchant at checkout. The merchant sends the transaction details to its acquiring bank for processing. The acquiring bank forwards the transaction request to the card network for routing it to the issuing bank. The card network identifies the issuing bank and sends the transaction for approval. The issuing bank reviews the transaction, approves or declines it, and sends the response to the card network while also notifying the customer. The card network relays the issuing bank's response back to the acquiring bank. If the transaction is approved, the acquiring bank deposits the funds into the merchant's account. If declined, it informs the merchant of the reason. If you are all buckled up, then let's begin with the first step of the payment flow, that is, initiating the purchase. In this section, we'll start with the first step, a customer making a purchase at a merchant. We'll also look at how the merchant captures the transaction details during checkout. Let's rewind to the 1960s. A customer walks into a shop and decides to make a purchase with a credit card. Instead of tapping or inserting the card, they hand it over to the merchant. The merchant uses a manual card imprinter, commonly called a knuckle buster, to make a carbon copy of the card details. These carbon slips are then saved to be deposited at the merchant's bank later for processing. We just saw the customer handing over their credit card, and the merchant making a carbon copy of it. But what happens next? Now, we'll dive into the merchant's role in processing the transaction. We'll also explore the key data attributes in the payment flow, and why they matter. In the 1960s, technologies like swipe, chip, or tap didn't exist yet. Let's consider Joe's Diner as an example. For each credit card transaction, Joe uses a knuckle buster to create a carbon copy of the card and writes down the transaction details. At the end of the day, Joe gathers all the carbon copies and physically delivers them to the acquiring bank for processing. If we visualize the batch of carbon copies as a table, each row represents a unique transaction with key details such as the merchant ID, merchant name, customer's name, card number, transaction ID, purchase amount, and transaction date. Each of these details plays a critical role in payment processing. Let's break down each important element in subsequent slides. Let's start by exploring the merchant ID. A merchant ID is a unique identifier assigned by an acquiring bank when a merchant sets up a payment processing account with it. A business can have multiple MIDs for their different branches or bank accounts or even business needs. But each MID is always unique to the specific merchant and acquiring bank. An acquiring bank registers the MI bid with the card network. In the past, when computers were more limited, the card networks maintained a physical registry that mapped MIDs to the corresponding acquiring bank. Next, let's look at the card details. If you were like me before diving into this topic, you might assume the card number simply identifies your account at the bank, right? Well, much like a Swiss Army knife, this single number holds multiple functions. Here are 4 key roles it plays. The first digit represents the card network. This helps the acquiring bank route the transaction to the correct card network. The first 6 digits represent the issuing bank. This enables the card network to direct the transaction to the right issuer. The next 9 digits are the customer's account number, which helps the issuing bank identify them correctly. The last digit is called the check digit. It's calculated using an algorithm like LUN to verify the card number's accuracy. Told you, it's more than just an account identifier. Don't worry about remembering them for now. We will bring these up at the right point in the payment flow. Now, let's talk about payment details. These details ensure transactions are accurately recorded on the customer statement. Think about how you check your banking app today. If you spot a charge you don't recognize, you contact your bank to dispute it. In the past, customers relied on monthly paper statements to catch unfamiliar transactions and raise disputes. In the previous section, we've seen merchants capturing payment details and sending them to the acquiring bank. We've learned key details like merchant ID, card information, and payment details. In the next section, we'll dive into what happens at the acquiring bank. We'll explore the challenges they face, how they handle the data, and why they use the card network to send transactions to the customer's bank. Going back to our example, at the acquiring bank, Joe isn't the only merchant depositing transactions today. Other businesses are also submitting their daily sales. Let's take Walmart as an example of another business submitting their transactions. Each merchant has a unique merchant ID assigned by the acquiring bank. Let's visualize the transaction slips in a table. In this video, we'll focus on the transactions from Joe's Diner and Walmart. Next, we'll see how acquiring banks organize these transactions back in the day. At the end of each business day, merchants like Joe's Diner, Walmart and others would submit their transaction slips to their acquiring bank. But sending stacks of paper to the card network wasn't practical. It would take truckloads. Instead, the acquiring bank recorded key details from all slips onto a single summary sheet, making it easier to forward everything efficiently to the card network. The acquiring bank must send transactions to the card network, which then routes them to the correct issuing banks. But why not send them directly? Imagine there are just 4 banks. An acquirer would need to connect with 3 others. That's manageable. But with hundreds of banks, including smaller local ones, building direct connections with each becomes impossible. That's where card networks come in. They act like a central postal system, allowing acquiring banks to submit transactions in one place, which are then routed to the correct issuing banks efficiently. Back then, there were 2 major card networks, Bank AmeriCard, now Visa, and MasterCharge, now MasterCard, each with its own system and member banks. So, how did acquiring banks know where to send a transaction? Acquiring banks looked at the first digit of the credit card number, commonly known as the card brand identifier. For example, Visa cards typically begin with a 4, while MasterCard starts with a 5. In our example, all card numbers begin with a 4, so the acquiring bank knows to route them to the Visa network. The acquiring bank first sorts transactions by card network, Visa in our case, and compiles them into a detailed file containing every individual transaction. It also creates an aggregated file, a summary grouped by merchant ID. This summary is key for reconciliation. Just like you'd double count a bundle of cash to avoid mistakes, reconciling millions of transactions helps ensure accuracy. One small error could take hours to track down. As we walk through the payment flow, we'll highlight the key reconciliation checks at each stage. Let's quickly recap what we've covered so far. Feel free to pause the video if you'd like to read through it in detail. In this section, we will be going over what role does a card network play in the transaction flow. Every day, card networks receive transaction files from multiple acquiring banks, each submitting on behalf of their merchants. This creates a massive volume of transactions, and the card network plays a crucial role in managing it efficiently and securely. At a high level, the card network performs 3 key tasks after receiving these files from acquiring banks. First, the card network ensures each transaction reaches the correct issuing bank. This is done using the first 6 digits of the credit card number, known as the Bank Identification Number, or BIN for short. Here's a mock BIN lookup table to illustrate how card networks map BINs to their respective issuing banks. A single bank can have multiple BINs. Since card networks sit between acquiring and issuing banks, they manage central registries of merchant ID or MID to identify acquiring banks and BINs to identify issuing banks. Second, once the issuing bank approves or declines the transaction, the card network receives that response and relays it back to the acquiring bank. And third, the card network calculates how much each bank owes, or is owed, and helps settle those amounts. We've learned that the card network uses the first 6 digits of the card number, called the BIN, to route the transaction to the issuing bank. Now, let's look at this from a data perspective. Let's go back to our data and see how card networks process each transaction. First, the network extracts the BIN, the first 6 digits of the card, and adds it as a new column. Then, it organizes transactions by BIN, creating a separate file for each one. Next, it creates a summary file by consolidating all transactions under the same BIN. Now comes reconciliation. The card network needs to confirm that it has processed all transactions correctly. It starts by counting all transactions from the mid-level summary files sent by acquiring banks. In our case, 7 in total from Joe's Diner and Walmart. Then, it compares that number with the total transactions in its own bin-level files, which we just saw as 7. As the counts matched, it means everything was processed successfully. That's why acquiring banks must send those summary files. At the card network stage, we saw how transactions are sorted by BIN and split into 2 sets of files, one with individual transactions and another with summary totals. Then, we've seen the card network reconcile using the summary files to ensure every transaction has been processed correctly. Now, at the issuing bank, we'll see how it receives the files from the card network and processes each transaction. Let's take the BIN 401256, which belongs to Wells Fargo Bank, as an example to understand the processing at the issuing bank's end. Wells Fargo would receive 2 files from the card network, one containing individual transactions and the other an aggregated file at the BIN level. Let's look at the individual transactions file. The bank follows a step-by-step process to decide whether to approve or decline each transaction. First, it verifies if the card is valid. It checks the cardholder's name, expiration date, and whether the card actually exists. Next, it checks if the customer has enough balance to cover the purchase. Then, based on its internal fraud rules, the bank makes a decision of approving or declining the transaction. Once processed, the issuing bank adds several key fields to each transaction. Let's take a quick look at them. Approval status indicates whether the transaction is approved or declined. Authorization code is a unique code assigned to approved transactions for tracking. Response code is a detailed code, specifying the reason for approval or decline. Response description is a brief explanation, corresponding to the response code. Settled amount is the final amount the issuing bank will send to the acquiring bank, after adjustments. Issuer reference ID is a unique identifier assigned by the issuing bank, for tracking and reconciliation. After processing the transactions, the issuing bank aggregates them by merchant ID. For reconciliation, the issuing bank compares the totals at the MIB level with those at the BIN level, checking both the number of transactions and the total amount. If they match, it confirms that all transactions were processed correctly. Finally, the issuing bank sends the individual transaction file, with responses, along with the merchant ID level aggregated file back to the card network. To quickly summarize, once the issuing bank gets the transactions from the card network, it runs a few checks, makes a decision on each transaction, and then sends back a response file, along with a summary file grouped by merchant ID, to the card network. Once the card network receives response files from the issuing banks, it has to send them to the right acquiring banks. To do this, it uses a central registry that links each MID to its acquiring bank. Then, it sorts the transactions by MID, and sends each file to the right bank. Relaying information is the second key task of the card network in the transaction flow. Now, let's move on to the third task, that is, settlement. To understand this, let's revisit our example. In our example, Chase is the acquiring bank, and Wells Fargo is the issuing bank. Wells Fargo, with BIN 401256, received 2 transactions from the card network, both originating from Chase. It approved one for $100 and declined the other for $50. Since only approved transactions matter, Wells Fargo owes Chase $100. But the flow of money doesn't just go one way. Let's say a Chase cardholder shops at a merchant whose acquiring bank is Wells Fargo. In that case, Chase becomes the issuing bank and owes money to Wells Fargo. Suppose the approved transaction in this scenario totals $200, then Chase owes Wells Fargo $200. Instead of both banks sending money to each other, the card network simplifies the process. It calculates the net amount owed between the banks. In this case, Chase needs to send $100 to Wells Fargo. This process is the card network's third key role. Settlement. After the settlement is complete, the money moves between banks. The acquiring bank, now aware of the approved transactions, deposits the corresponding amounts into the merchant's accounts. For any declined transactions, the acquiring bank checks the response from the issuing bank and tells the merchant why the payment didn't go through. Meanwhile, the issuing bank sends a monthly statement to the customer. If the customer spots a charge they don't recognize, they report it to their bank. That information is then passed through the card network back to the acquiring bank, which is then shared with the merchant. And that brings us to the end of the credit card transaction cycle. Like the gears of a well-oiled machine, every part works in harmony, revealing the complexity behind even the simplest payment. What's fascinating is that this system was developed in the 1950s and 1970s, without the modern tech we have today. Back then, some steps took days or even weeks to complete. But as technology advanced, so did the payment process and its ecosystem. We would like to give you a quick glimpse at what happened next. By the 1970s, credit card use had grown so fast that manual processing couldn't keep up. Submitting paper slips to banks was slow and costly. Magnetic stripe cards helped by capturing transaction data electronically, replacing carbon copies. But banks still struggled with the growing volume. And computers weren't common yet. That's when payment processors emerged. They brought in the tech and infrastructure needed to scale, replacing manual processing and simplifying reconciliation. In the next video, we'll look at how the payment flow evolved into the modern system we use today, from the rise of payment processors to the birth of payment gateways in the age of online shopping. Stay tuned, and we'll see you there.